Well, good morning and welcome to day 11 of financial accounting for the fall 2022 semester. Today we are going to be finishing up chapter 5. We're going to be picking up with exercise 7 in chapter 5. So we have 7 through 10 left to go. And since we'll be finishing chapter 5 today, the chapter 5 exercises should be ready to submit for grading by the end of the day before midnight tonight. And then the chapter 5 problem, which goes back to being a regular chapter length problem as opposed to the comprehensive problem you had for chapter 4. The chapter 5 problem should be submitted by Thursday. And then Thursday we'll start our work on chapter 6. Before we start with exercise 7 today, does anyone have any questions? Anything you want to talk about from last class? Last class, we continued working on chapter 5, looking at recording purchases and sales transactions. Sure. And so there was a request to look at part B and C for exercise 6, so we'll start there. Anything else that anyone wants to make sure we talk about today? Okay, so as we look ahead, just a reminder of what's coming up. So we'll be covering chapter 6 today and Tuesday, and then the chapter 6 problem will be due next Thursday, October 6th. At that point, we will be finished with our chapters that are on exam number 2. And so next weekend, not this coming weekend, but the following weekend, we will have our second exam. Again, just looking ahead, you can see that there are a couple extra credit problems for chapter 6. Extra credit means you can do them or not do them, and it doesn't count against you if you do not do them, but there is extra credit toward the problems if you complete those extra problems. There was not a problem in this edition, this new edition of the book, that covered everything I wanted in the problem, but I didn't like the idea of requiring you to do more than one problem for the chapter. So as we look ahead to chapter 6, those extra credit problems, if you choose to do them, also would be due on Thursday of next week. And then the exam, as you can see here, we do October 9th, and there's a practice set as there is for every exam. There's a practice set to go along with those. I will be scheduling a review session for that second exam. I only heard from a very small number of people who said, yes, I'm interested, and nobody has given me a specific time or a couple different times of when you might be willing and able to attend. So I'm just going to go ahead and schedule that practice, the review for the exam. I think it's going to be next Wednesday morning. So my expectation would be in that review, we would go over some or all of that practice set, just like we did in the first review session for exam 1. Also, if you look at the syllabus, you'll notice that the week after that, there are no classes on Monday and Tuesday. So Monday is Columbus Day and Tuesday is Faculty Development Day. So no classes Monday or Tuesday. Obviously, that includes our class on Tuesday, will not meet. And so with that long weekend, I really just want to make sure you recognize the exam is still due on Sunday. If you want to be able to take advantage of that long weekend, if you're going home or anything like that, the exam is still due on Sunday. And so you should plan ahead and take it before maybe you go home for the weekend or whatever your plans are. We did have a few people on the first exam that had we had a few people on the first exam that had other obligations on the weekend, and for those people, you really should have taken the exam before you left, not after you returned. So I'm just mentioning that now. But my expectation is that we will have a review session next Wednesday morning. I still have to work out the time around my other obligations. So I'll put that in the announcement later today, once I have a confirmed time for that. Please plan ahead, plan to take the exam no later than Sunday night. And if you want that long weekend, just make sure you take it on Thursday or Friday, or really you can take it any day after you finish the chapter 6 problem. So we'll finish chapter 6 on Tuesday. There's nothing to prevent you from then doing the chapter 6 problem, the extra credit problems, if you choose to do that, and then take the exam. We aren't going to do anything on Thursday in class that would be from chapter 6 or from something that's on that exam. So let's go ahead then to the exercises. We had a request to take a look at letters B and C. So I'm going to start with letter A, just because I want to make sure we're seeing everything. Thinking about the entire scenario here. Remember, this is the same scenario as we talked about in chapter 5, but in it's not chapter 5, excuse me, exercise 5. In exercise 5, we were the seller, and then in exercise 6, same scenario, but we are now the buyer. So let's take a look at exercise 6, and we will just start from the beginning. Showcase Company, a furniture wholesaler, sells merchandise to Balboa Company on account. The total of the invoice is $254,500, and the terms are net 30. So that means they're not offering a discount for paying early. The full amount of the invoice is due 30 days after the invoice date. The cost of the goods sold is $152,700. Showcase then issues a credit memo for $30,000 for merchandise that was returned prior to Balboa Company paying the original invoice. And we have the cost of the merchandise that was returned there of $17,500. So we're asked to journalize Balboa's entry for the purchase. As always, we are assuming that the companies are using the perpetual inventory system. So when they acquire new inventory, they add it directly to the inventory account. And because they are buying it on credit or on account, we need to show the liability to pay for that merchandise. Now, the invoice isn't due for 30 days, and prior to them paying the invoice, they return some merchandise, and the merchandise they returned had a cost to them of $30,000. The seller, Showcase Company, had a cost of that merchandise of $17,500, but of course they had to cover their selling and administrative expenses and hopefully make some money on that sale. And so the amount they charged their customer was $30,000. So at the time they make that return, they're going to show in their accounts payable, hey, we don't have to pay that anymore. We returned $30,000 worth of merchandise. And because they use the perpetual inventory system, they need to take that from their inventory as well. And so the debit to accounts payable reduces the liability. We now owe only $224,500, and the credit is to inventory because we no longer have that inventory available. We need to update our records. And then the last thing, the last piece of that is now we, Balboa Company, are going to pay the amount we owe. So we're going to use cash to do that. And we're going to remove the total amount that we are paying from the accounts payable account. We want to show that we don't owe that amount any longer. And how much do we owe? Well, we owed $254,500 initially, but then we returned $30,000 of that. So that leaves $224,500 that is due. And we would pay that using cash. Ashton's good. Okay, any other questions from anything we've talked about up to this point? As I was saying before we got started in the intro part, so we've talked about purchases, sales, we've talked about discounts, returns, and allowances. We've discussed using credit cards and how that might affect our records. We've talked about perpetual and periodic systems, although we're not covering specifically how to use the periodic system in class because that's in one of the appendices to the chapter and you are not responsible for that. So what have we not yet covered? Well, we haven't covered the idea of sales tax and how that might impact our records. So what you should recognize is that most of the time, if we are a wholesaler in particular, we are not going to be charging our customers sales tax. They're not going to be paying us sales tax because sales tax is paid by the end user, by the ultimate consumer. So a wholesaler selling to a retailer is not going to charge sales tax. The only sales tax that would be due would be on product that's being used by the purchaser. The retailer then would charge its customer sales tax on that final sale to the consumer. But normally a wholesaler selling to a retailer is not going to have sales tax included at all. So in this case, we are selling a product that is subject to sales tax. And we're selling $640,000 of merchandise on account, subject to a sales tax of 7%. The cost of goods sold was $385,000. So the other thing to recognize about sales tax is that tax does not belong to the seller. The tax does not belong to the seller. They are acting as a conduit, as a collecting agent for whoever the taxing authority is, the state, local, federal government, whoever is levying that tax. The retailer is assisting in that process by collecting the tax on behalf of the state. So from the moment they charge their customer that sales tax, they create a liability to pass that money to the taxing authority. Again, the state, local, federal government, whoever it is who levied that tax initially, whoever has the right to receive that tax. So they sold this on account. They're going to be reporting an account receivable for the total amount that is due to them. And so the amount that is due to them, just going to put the calculation here on the screen. The amount that's due to them is not just the $640,000, but $640,000 plus 7%. So to find out the total, so just calculate here. Okay, so $640,000 times 1.07 or 107%. We're just adding the 7% sales tax on top. And that gives us $684,800. So the total billings to our customers maybe plural, would be $684,800. We're going to show that full amount as being receivable because that's how much our customers need to pay us. But on our income statement, we are only going to show as revenue the part that actually belongs to us, $640,000. The difference, the other 7% or $44,800 is a liability. That part is what we might call a balance sheet transaction. We report a receivable on the asset side under current assets, and we immediately at the same time report that payable. That's not our money. It doesn't show up on our income statement. It's not part of our sales. we immediately create a liability to pass that money to the state, local, federal government, whoever assessed that tax. So from that transaction, the only part that affects our income statement is that sales, that's our revenue amount. The tax doesn't show up on the income statement at any time. And not on our end, I should say. The people who had to pay the tax, if they are a business, that tax is an expense for them. But on our part, we're charging the tax. That tax does not belong to us. The reason that I'm stressing this is certainly a potential business issue. It sometimes can create very serious and legal difficulties for a business. Even if they recognize it correctly, as we just did here, think about it. The customer is going to pay us the full $685,000, but $45,000 of that we need to be able to send to the state when it's due, which may be the 15th of the next month or something like that. It's in our bank account. We have the cash. The temptation then is there to use that cash to keep running our business without recognizing, without taking into account, hey, we need that money available when the tax bill is due next month. As I said, this is just one scenario. We'll talk about it when we get to the current liabilities chapter, that this is just one little piece, one drop in the bucket. There are many other taxes that companies are collecting. The majority of them are coming from their employees in the form of withholding for federal income tax, state income tax, Social Security, Medicare. And the temptation is there to use that cash to keep your business running. And then the problem arises when you don't have the cash to pay the tax bill. Clearly that's a legal issue for the company. Any questions about that first entry though? Biggest point, it's not ours. It's not ours. It doesn't show up on our income statement at all, but it does show up as an in and out or a wash on our balance sheet. Our assets went up, but our liabilities went up by exactly the same amount at the time we did the billing. The second part is because we use the perpetual inventory system, when we sell the inventory, we immediately need to remove it from our inventory account at what we paid for it, at our cost, not what we charge the customers, but what we had paid for it. And that moves off our balance sheet and onto the income statement as an expense, cost of goods sold. So there's one sales tax payable entry here for $45,000. There very well could be other entries as well for other taxes that we owe. And I've given you some examples of what some of those taxes might be. Other taxes that the business might pay. Again, we'll talk about these a little bit more in chapter 8, would include things like state and federal unemployment, workers' compensation costs, other fees and taxes like that. And so at the time that we pay the state tax department, we are going to use cash, of course, to do that. So we're using $61,750 in cash, and we will reduce our liability or our outstanding obligation to the state, in this case, state tax department, by that same amount. So even though we had only credited $44,800 in part A of this exercise, it appears that we had other outstanding liabilities to the state as well. Any questions so far? Yet another consideration for a merchandising company. in particular, if they're selling to a consumer, if they're a retail operation. Wholesalers are not dealing with the sales tax issue at the same or to the same extent as retailers would be. In case you are not aware, every jurisdiction has their own determination, their own laws about what is taxable and what rate you pay. So in New York State, when I was a kid, it used to be that every county in New York State outside of New York City charged the same sales tax. So the sales tax rate was 7% across the state, other than in the city. In probably the 80s, 1980s, maybe the late 80s, each county recognized that they could tinker with that sales tax rate. And I'm honestly not sure if a law changed at that time or if they just recognized, hey, that's an untapped source of revenue. And so you started to see incremental increases in the county portion of the sales tax. So it used to be 4% for the state, 3% for the county, and then the county started raising theirs. And so that's why you see some counties now with an 8 or 8.5% tax rate, and some that are still at 7. Again, when I was younger, Pennsylvania was 6%. The entire state was 6%, and I'm not 100% sure if that's still true. Each jurisdiction also decides what items are taxable. So in New York State, clothing had always been taxable, and in Pennsylvania, clothing was not taxed. So they had a lower tax rate to begin with, and there were products like clothing that they did not tax at all. In New York, most food is not taxable, but prepared food, hot food, is taxable. If you go into a restaurant, you're going to pay sales tax on the full amount. But if you are in a grocery store, the majority of the food you buy in a grocery store is not subject to sales tax. In Virginia, where I went to school, food was taxable in the grocery store, but the rate that you paid in a grocery store was 4.5%, and in a restaurant, the rate of tax was 7%. Again, each jurisdiction is going to make its own determination of what's taxable and how much tax is going to be applied to that product. So, next topic, any questions on anything so far? Okay, so next topic. We've been talking about, for the last 2 classes, a company using a perpetual inventory system. When they buy new product, they add it to their inventory account. When they sell product, they remove it from the inventory account. When they accept a return, if that product is still in good shape, it's not damaged or anything, they're going to put it back in the inventory account and show that it's available for sale again. However, that inventory system is probably not perfect. So it may be, and you may have had this experience, you take something up to the checkout counter at the grocery store and they scan it, but the barcode isn't found, and so they just enter the price of the product. You ever seen that happen? So if the barcode isn't found, then it's not coming out of their inventory because the computer, I'm going to animate the computer for a second. The computer doesn't know what was sold. And so it didn't remove it from the inventory because it didn't recognize that code. Certainly that happens. There are other reasons that product might no longer be available for sale in the store, but that it wasn't actually sold. It hasn't actually been moved to cost of goods sold. So what else might happen to product? And we'll keep using the grocery store example because most people can relate to that. What else might happen to product in the grocery store that the store doesn't have it anymore, but it wasn't actually sold and recorded properly in the computer? What else could happen to it? It's gone. Where did it go? What do you think happened to that, the food that we didn't sell or didn't record as sold? I'm sorry, what was that? Okay, so we could have given it away. So maybe that, you know, there's a Girl Scout troop in the entry and the store said, here, have some, you know, canned goods for your food drive. Sure, that could happen. Now, I'm going to suggest that they would, in the ideal world, they would still record that because they can take a tax deduction for that. But that's one thing that could happen. What else might happen to it? It expired, so they had to throw it away. That happens certainly in you know, the produce section or the dairy section more quickly than it's going to happen in the canned goods section. But definitely that could happen. Something, for some reason, they couldn't sell that product anymore. Now, again, ideally, they should be recording that. But in the produce section in particular, it's hard to measure the quantity of, you know, bananas that might go bad or get put on the reduced for clearance kind of shelf, whatever. What else might happen to it? Things sometimes get stolen in a grocery store, do you think? I'm sure that happens. Who stole it? Well, it could be someone who came in acting as a customer. It could be an employee. It could be innocent, that the person, you know, it just got left in their cart. It didn't get scanned at the checkout, or didn't get scanned properly at the checkout, whatever. It could be intentional theft. All of those things that we just talked about, and one other thing, one other possibility, if you've ever gone into a BJ's wholesale club, you've seen this for sure. One other possibility is it got given away as samples to the customers. Again, ideally that would get recorded, but sometimes things don't happen the way they ought to happen in, you know, when we live in the real world. So all of those things that we just mentioned can happen. And the inventory that we paid for, we recorded in our inventory records, we no longer have, but we didn't actually sell it, or the computer didn't record the sale and remove it from the inventory. So what do we have a special term for that. We call it, and you can see it right in the title of this exercise, we call that inventory shrinkage. When the product is no longer available for sale, but we haven't yet recorded the cost of that product. So how do we catch that? How do companies find out about that? Don't they think that their perpetual inventory system is just keeping up with that? Well, no, everyone recognizes that there may be some discrepancies. We hope they're small, but there may be some discrepancies between what our inventory records say we have and what we actually have on hand. So what do we do about that? Well, every single company, regardless of whether they use a perpetual system, a periodic system, every single company is required, at least on an annual basis, to do a full, what we call a physical inventory. Again, you can see that term in this exercise. We do a physical inventory, which means we don't just look in the computer to see what it says we have. Instead, we actually go out and count every single item. That's called a physical inventory. And then we compare the results of that physical inventory to what our computerized accounting information system, what our records show we have. And we need to then make an adjustment to our records to reflect what we actually have on hand. Now, we expect a certain amount of inventory shrinkage. And depending on what type of organization, what type of business you are. I can't put an exact number or an exact percentage on what that amount would be, but we expect there to be some difference. There are 2 times that we would be maybe alarmed about that difference, where it actually is more of a concern for us. One is if the amount is material, and I've defined that term for us before. We typically think of a material amount as being more than 5% of the total. So if it's a big enough number to matter like that, then we're concerned. What happened to that inventory? If we have that much of an issue with theft or destruction of property or whatever, then we're going to be more concerned about that and need to take additional steps to try to prevent that or to safeguard the assets of the company. The other time that we are going to be more concerned about this difference or this inventory shrinkage is if we believe or know it to be the result of some kind of fraud being perpetrated on the company. And so no matter how small the number is, if we think it's a result of, or know it's a result of fraud, we are going to be concerned about that. That's definitely something that needs to be addressed. But if it's just routine inventory shrinkage, we were giving away some cheese at the cheese counter. Some of the produce went bad and had to be discounted, sold at maybe even sold at a loss or thrown away. We're going to be less concerned about that because that's just part of the normal course of operations. It's part of doing business. So this exercise says Omega Tire Company's perpetual inventory records indicate that $3,145,000 worth of merchandise should be on hand at the end of August. We went out and counted it, and we assigned a value to what we had. And that physical inventory indicated that we actually have on hand somewhat less than that. We have $3,113,500 of merchandise actually on hand. Now, one thing to point out, if that number is quite dramatically different, we might want to, I don't know, check our math, make sure that we actually counted it, make sure that there isn't inventory sitting someplace else that we just neglected to count. Where else might it be? Well, it might be in transit from the seller to us, right? We might have purchased some additional inventory that we recorded in our records, but we don't physically have on hand. It might be that we have it sitting at some other location. Maybe we have it on consignment at some other seller and we forgot to count that. We still own it. We haven't recorded the sale yet, but we forgot to count it because it's not physically present in our warehouse or in our store. So those kinds of things could certainly happen. It could be that we just miscounted. It could be that there's some inventory sitting under a tarp in the back room. Oh, we forgot and we didn't count that. So those are things we would want to look at as well. How confident are we that that is the correct amount for the inventory? And so I just want to find out how much are we missing? How much discrepancy do we have here between our physical count and what our records say? And the difference between those numbers is a pretty small number, 31,500. $31,500. So that's only about 1% of the total. And so based on what I've just been explaining, would we be worried about a number that's that small? It's just 1% of the total. Unless we think it's the result of fraud. We're not going to be too concerned about this 1%, especially if our typical adjustment, our typical inventory shrinkage is usually in that range. Then we're just going to say, again, it's just a part of the God bless you, part of the cost of doing business. We just haven't recorded that cost yet because we didn't know about it. And so what we are going to do is record that difference, 31,500. We need to remove it from our inventory account because we did a physical inventory. We counted what we had and we don't have it anymore. So we cannot continue on our balance sheet to show that we have that inventory when we know we don't have it. But what are we going to call that? We're going to call it part of the cost of goods sold. It's part of the cost of doing business. We just haven't reported it yet. Again, this could be samples that are given away. It could be merchandise that was damaged or went past the date. Or as someone pointed out, we may have given it or donated it to a worthy cause. Maybe it was stolen. I'm not suggesting we should just ignore it if it's stolen. However, we still have an obligation to report that as an expense, as a cost of doing business. And so at the end of each period, at the end of each accounting period, and at a minimum once a year, we have to do that physical inventory and update our records and do the required adjustment. When our auditors come, they're going to want to confirm our inventory, confirm that what we say we have is actually what we have on hand. And so for that reason, the full physical inventory frequently corresponds with the auditor's visit. Questions about anything so far? Drawings off the screen and we'll keep going. So in chapter 4, we introduced the idea of the classified balance sheet where we took our assets and divided them into some subcategories such as current assets, property, plant, and equipment. We talked about the possibility of investments category, natural resources, intangible assets. We'll talk about those more in chapter 9 in a few more weeks. We talked about dividing our liabilities based on when they're due and what we're going to use to pay for them. So we usually have 2 classes or 2 subcategories of liabilities, current liabilities and long-term or non-current liabilities. We divide our equity. We've always been dividing our equity into 2 subcategories: contributed capital representing investments from our stockholders, and then the retained earnings, the part that was earned by the company. What we're going to be doing in this exercise is doing a similar process to what we did when we classified the balance sheet. We're now going to be classifying the income statement. We're making it from a single step income statement where we listed and totaled our revenues, we listed and totaled our expenses, and then we just found the difference to be our net income or our net loss. We're going to add an extra step in, God bless you. We're going to add an extra step into the income statement now. And for the same reason that we did that on the balance sheet, because it will give the user of these financial statements a little bit more detailed information. It does not change the bottom line. Our net income or net loss is going to be exactly the same from the simple income statement or single step income statement to the multi-step income statement. The bottom line, our net income, net loss remains exactly the same, but we're just going to add an interim step into our calculations. So we're going to be constructing an income statement using all of the data that are provided here. And I shouldn't say using all of the data, using all the relevant data that are provided in this exercise. And the reason I needed to make that change to the language I was using is as I'm looking at these account titles, I can see some that we're not going to be using at all. because they're not income statement accounts. So starting with the very first one, accounts receivable, well, that's a balance sheet account. That's an asset. So it's not going to go on our income statement at all. Accumulated depreciation, you know now from chapter 3, is a contra asset account. Doesn't go on the income statement at all. Building, cash, common stock, dividends, inventory, notes payable, retained earnings, salaries payable, store supplies. All of those accounts I just mentioned, well, with the exception of dividends, all of those accounts are balance sheet accounts. Dividends belong on the statement of stockholders' equity. And so we're going to be looking at only the income statement accounts. Let's take a look at the format here then. You'll notice, as with all of our financial statements, we start with a 3-line heading, name of the company, Royal Furnishings Company, name of the financial statement. In this case, it's the income statement. It could say balance sheet or statement of cash flows or statement of stockholders' equity there. And then the 3rd line is always the date or range of dates that it covers, keeping in mind that the balance sheet is a specific date and all of the other financial statements cover a range. So it's important, it's critical that we say, how long a period is this? In this case, it's for the year ended March 31st, 2019. All income statements start with sales or revenues. All financial statements start with sales or revenues. So let's find our sales number here. There it is, $8,245,000. If you think about what we discussed with the simple or single step income statement, we then, if this was our only revenue account, we would then go right to our expenses and we would list and total those expenses. And we talked about what order those expenses should appear on our income statement. And what we had said was the largest dollar amount ones are generally going to come first, largest to smallest, except if there's miscellaneous expense that would go last. One thing we have not seen on most of the income statements we have done, maybe all of them to this point, we haven't seen an income tax expense line. It is typical to break out the income tax expense. That is not to lump it in with the other expenses anyway, even on a single or simple income statement. But on this multi-step income statement, the classified income statement, for a company that's selling a product, so it's going to be a little bit different if you are selling a service, but if you are selling a product, the second line should be cost of goods sold. If you're selling a service, some service companies also choose to have this next interim step, but they aren't selling a product, so they don't say cost of goods sold, but they might have a line that says cost of sales. So cost of goods sold, there it is, right at the top of the screen right now, $5,500,000. Now I'm going to put the negative sign in front of that to remind us to subtract. As I've told you before, the software will accept that as long as the number is correct, they'll accept it with the negative or without the negative sign, unless it specifically tells you to use or not use it. And it does do that sometimes. The problem would say use a negative if you're subtracting. In this case, it does not say, and so you can use the negative or not. I like to use the negative because it does remind you to subtract. And so we're going to subtract to get to our first intermediate or interim step in calculating our net income, and that is what's known as our gross profit or gross margin. So for some reason, this textbook likes to refer to that step as gross profit. I'm just letting you know that the term gross margin means exactly the same thing. And you are more likely to see that step referred to as gross margin than you are gross profit. But this book, for whatever reason, likes the term gross profit. And so that's what the software uses, and that's what you'll see in your textbook. In class, I use both because gross margin is actually much more common. And so I want you to be aware, if you are looking at the company that you chose for your project, for example, if you're looking at their income statement, you're almost certainly going to see gross margin, not gross profit. I have yet to figure out in the 3 years I've been using this book, why they do that. I don't know. So that's our first interim step. That's something new we haven't seen before this chapter. The next step is to list and total what are called our operating expenses. These are also referred to as selling, write this on the screen, just put them over here. So gross margin is the same as gross profit. And where this lists expenses, we would normally call those operating expenses, and that includes selling expenses. So the cost of having a store, any commissions we pay to our sales force, that kind of, any delivery expenses, and I'll come back to that in a moment, but any delivery expenses to get the product to our customers is a selling expense. Marketing, if we're doing some advertising, that would be a selling expense. And the other category that goes here is frequently called general and administrative expenses. General and administrative. You might just see it called administrative expenses. This would be the cost of the home office, of paying the accounting staff, the human resources department, the billing department, the accounts payable that's in charge of paying our bills. So all of those types of back office staff are considered general and administrative. And so in this exercise, our next step is to list and total those expenses. So we have selling expenses and administrative expenses. Selling expenses are given as $575,000. Oh, I just realized, so the accounts that are all listed here are in alphabetical order for no particular reason. Administrative expenses are given as $435,000. There's another name for these operating expenses. We sometimes refer to them as period expenses, expenses that are instantly on the income statement in the period in which they are incurred. We contrast that with our cost of goods sold, which are called product expenses or inventoriable costs, because that cost of goods sold represents the cost of the inventory, and it stays on our balance sheet as inventory until it's sold. And so we need to contrast our product expenses, the product itself that we're selling, with our period expenses, the operating expenses or selling general and administrative expenses. Add those together to find our total SG&A, or selling general and administrative expenses, $1,010,000. And I guess to be consistent, I should put a negative in front of that to remind us that we're going to be subtracting those as well. One other comment I want to make is the concept of freight. And I had somebody in the online class ask me about this in an email over the weekend. And what she had said is, why is freight considered a selling expense? Why wouldn't that be part of the, or maybe it was the other way around. I can't remember which way she asked. She either asked, why is it a part of the cost of goods sold. Why isn't it a selling expense? I think that might be what she asked. And so I need to clarify this. Freight in is to get the product to us from our supplier. And that freight in is part of cost of goods sold. In other words, we look at it as part of the cost of the inventory. If we had to pay the freight to get the product to us, that's part of acquiring the inventory. But sometimes we have freight out, which is the cost to get the product from us to our customer. Oops. And that is considered a selling expense. So it seems a little, I don't know, nitpicky or complicated, but there are two different sources of freight, of delivery expense. The cost to get it to us is part of cost of goods sold. The cost to get it from us to our customer is a selling expense. It's seen as a period expense, not an inventoriable cost. And so our next step here, so we have our gross profit or gross margin, which is what's left of our revenues after we pay for the inventory that we sold to them. Now we're going to take our next step, which is subtracting our total expenses or selling, general and administrative expenses from the gross profit. So this would be the either operating income or operating loss. Because our gross profit exceeded our selling, general and administrative expenses, that would be an operating income. And then on a corporate income statement, there may be some other revenues and expenses that we consider not part of our continuing operations. We also refer to these as being below the line or non-operating items. And in the other information that's given for this exercise, I see interest expense here. That's an expense that we have not yet included. That's a cost of borrowing, right? So we must have borrowed money. And now we're paying interest expense on that money. That is considered a non-operating or below the line item. If we had interest income, so if we had some investments, maybe we have some excess cash in the off season and we put it into some kind of an investment like a CD or a money market, or maybe we invest in short-term government bonds or something like that. If we had interest income, that would also be included down here. Not to get too far afield, but there are some other types of non-operating items, such as if we have a segment of our business that we have discontinued, if we're trying to sell it or shut it down, that's considered non-operating. If there has been a major change to the accounting rules, GAAP, what we're learning this semester, if there's been a major change and we had to restate our financials from the previous period and it had a dramatic impact on our financials, that would be included below the line here or under other or non-operating items. If we had a major catastrophic loss, so you may have heard that Hurricane Ian is bearing down on the west coast of Florida right now. And it could be that there are some dramatic losses for businesses there. To the extent that those losses were uninsured, that would be considered a below the line item or a non-operating item. And so we take all of those into account, and then we have our net income or, whoops, got extra zero in there, or net loss if it was negative. And so this is an example of a multi-step income statement. You can see that it is a little bit more complicated or complex than what we learned in chapter 1 and have been doing since then. The bottom line, though, would be still exactly the same. If this company used a simple income statement, it would still have the same net income at the bottom. But by putting in those additional steps into the interim, the middle part of the income statement, it helps decision makers to focus in on the most important information. So, for example, I explained briefly about discontinued operations. A company has made a decision that they're shutting down or selling off part of their business. Maybe that qualifies then as a discontinued operation and is listed separately at the bottom. Why would a company want to do that? Well, because they don't want people making a decision about their company based on that information, because that information isn't expected to be around. They're selling that or shutting down that operation. So they don't want decision makers to look at that information and think that's going to keep happening year after year, because it's already been determined, no, that's not part of our future. So by doing this multi-step income statement, it helps decision makers to learn a little bit more about our business and hopefully make a better decision, whatever decision it is they're trying to make. So final step here of letter B, what is the major advantage of the multi-step income statement over the single step? Does it show the value of total expenses? No. Well, it shows the total operating expenses. Does it present the value of total revenues? Well, if we had interest income at the bottom, that wouldn't be added in with the sales. We've broken up those, we would have been breaking up those revenues. Is it less complex to prepare? Definitely not. So the final one, I've already eliminated all the other options. The final one must be the correct one. The multiple step income statement shows the relationship of gross profit to sales. In other words, we can see what's left of our revenues. We maybe turn off that speaker or something. We can see our sales and we can see how much of our sales went to just pay for the product that we're selling. And that relationship would look the same whether we make the product or buy the product. Our focus for this semester is on companies that buy the product from from their supplier and resell it to their customer in essentially the same form. In managerial accounting, second semester of accounting, we shift our focus to companies that are actually making that product. One last comment before we move on. One last comment. So when I talked, and I probably should have said this in the previous exercise, when we were talking about inventory shrinkage and taking a physical inventory, if you remember what I said was when we take a physical inventory, we count how many of each type of item we have, and we assign a value to it. And our next chapter, which we're actually probably going to at least get started on today to make sure we have enough time. Our next chapter is on inventories, and we spend the entire chapter talking about really that question of, well, how do we assign a value to it? How do we know how much it costs when we might have paid different prices? Right now, I'm sure everybody's aware that we're in a period of pretty high inflation, about 8.3% of latest numbers. And so we can expect to be paying about, on average, 8.3% more right now for any product that we're buying. That holds true for businesses as well. If they're buying inventory from their supplier and paying 8.3% more or some other number, how do we know how much the inventory we have left is worth? How do we know if we paid $9 for one item and $10 for the same item the next month, How do we know how much to say it's worth on our records? On our income statement as cost of goods sold, on our balance sheet as that asset inventory. And so in chapter 6, we're going to answer that question of how do we assign that value? How do we know how much it's worth? Counting the items is really the easy part, to know that we have 10 widgets, or we have 12 cans of soup or whatever. That's kind of the easy part. Yes, it's tedious. You have to actually go out and count them. But knowing how much to assign as the value is a different question altogether. Yes, sir. It depends on whether it's freight to get it. The freight to get it to us from our supplier is part of cost of goods sold. Freight to get it out to our customers is a selling expense. And so you have to know where the transportation was happening. Is it from our supplier to us? If yes, that's cost of goods sold. If it's from us to our customer, then it's part of the selling expense. Who has to pay the expense? So that's a whole separate question. So let me put that on the screen here. We can talk about that for a minute. So when you order product from a company, let's say, you are going to, now you have to have enough market power. If I'm ordering something from Amazon, I'm not going to negotiate the freight, right? It is what it is. But if I am a big customer and I'm ordering full truckloads of freight of product, then I might have some ability, some power to be able to negotiate, well, who has to pay the freight on this? That is a concept that's known as FOB, or free on board. And this is, I'm glad you asked the question, because this is something we would typically talk about in chapter 5 in this chapter. So who has to pay the freight? The simplest answer to that is whoever owns the product pays the freight. Whoever owns the product is responsible for paying the freight. You own it, you've got to transport it. So that brings us to the next question. Well, who does own it? Who owns it while it's in transit? Who owns it while it's on the truck being or on the ship or on the plane or however it's being shipped? Who owns it while it's going from the seller to the buyer? And there is not just one answer. There's no simple answer to that question. It depends. One thing I can tell you for sure is if you use a common carrier, so a common carrier would be, would be something like UPS or FedEx, or if you have a whole truck full of merchandise, it might be, I don't know, Schneider or Covered Wagon, or there's lots of trucking companies that are out there. They're referred to as common carriers because they're carrying product. That's their job. That is the business they are in, is to provide freight or transportation services, logistics like that. What I can tell you for sure is if you order something from Amazon and FedEx is bringing it to your house, FedEx never owns that product. They are definitely responsible for it. And if they damage it in shipment, if their truck has an accident or something like that, they're definitely going to be responsible for the cost of that product, but they don't own it. Okay? They're providing a service, which is transportation or logistics, getting that product from the seller to the buyer. But who does own it? Does the seller own it? Does the buyer own it? It depends. It's negotiable. when you buy something from Amazon, the terms of that sale are almost certainly, I can't imagine a scenario where they would not be FOB shipping point. Whoops, I capitalize that. FOB shipping point. Free on board shipping point. What that means is the title, the ownership, title transfers upon shipment. So it leaves the seller, it's now the property of the buyer. When do they charge your credit card? At the moment they ship it, right? They charge you when they ship it. It's yours. You've paid for it or been charged for it. But if you are, again, a large customer that has some market power, some ability to negotiate, you might negotiate the other most common. So these are the two most common, FOB destination. And in that case, title transfers when it reaches the buyer. And so if it's shipped FOB shipping point, the buyer owns it while it's in transit. The buyer is ultimately responsible for paying for that freight. Now I'm going to ask you to set aside, if you have Amazon Prime and you don't pay separate shipping charges, I get that, but in essence, you are paying for them. You're just paying for them up front when you pay your Amazon Prime subscription price, right? You own it while it's in transit. You ultimately are responsible for paying that freight. However, you're not responsible for arranging the freight. Can you imagine that scenario where every time you order something from Amazon or wherever you like to order from, if you had to then call UPS or FedEx and say, hey, I just ordered something from Amazon, could you go pick it up and bring it to me? And they're going to say, okay, where is it? I don't know. How often do you know where something's shipping from when you buy from Amazon or any other online seller? You generally don't. You are not calling FedEx or UPS and asking them to pick up. Amazon or whoever the seller is going to arrange for that shipment, but ultimately you are responsible for paying for it. You own it while it's in transit. But if you have the product shipped FOB destination, it still belongs to the seller until it gets to you. The seller is going to be paying the freight. The seller's responsible for the freight. And so, Patty, that was a really long explanation to a good question, but does that kind of help answer your question? Okay. And one other comment, I said that these are the two most common, FOB shipping point, FOB destination, but companies can negotiate whatever other title transfer point they want. And it's actually a pretty critical question in some cases. Let's think about it. Remember back in chapter 3 when we talked about how do you know you've earned the revenues? The SEC says you can, once you have earned the revenues based on their 4-step test, you claim them, you put them on your income statement in that period when you meet the 4th of those 4 criteria. And the 4 criteria, just as a reminder, were: you have an agreement between the buyer and the seller, the price is fixed or determinable, you have delivered the product or performed the service, and reasonable assurance of collectability is in place. So the third one of those 4, you have to have delivered the product. Well, where is the product? At what point is the product considered delivered? Well, it's considered delivered when it becomes the property of the buyer. Now, in some cases, that's really obvious. So you go into a grocery store and you put groceries in your cart. Do you own them while they're in your cart? No, you haven't paid for them. Something happens, you realize you forgot your wallet or whatever, and you leave the cart and leave the store. Those groceries were never yours. even in one of those really cool high-tech stores where when you put it in the cart, it gets added to your bill and you don't actually have to check out, you just leave the store and then it gets charged. It doesn't get charged until you leave the store, even though it's adding them up as you're in the store. That's really obvious. Title changed hands when you checked out at the register and you own them, you take them, the grocery store claims the revenue at the time you go through the checkout and pay for your order. But think about this scenario. And I apologize, y'all know that I'm not from Jamestown, so I'm not as familiar with the manufacturing companies here in Jamestown as I am those in Cattaraugus County where I live. But let's just say Cummins Engine, nice big manufacturing company here in Jamestown, very large company. Let's say that they have an order, and I don't know a lot about their business, but let's say they have a big order and they're shipping, just pretend this is possible. If you know anything about Cummins and I'm saying something that doesn't make sense, just bear with me for the sake of this example. Let's say whoever uses Cummins engines had placed an order for 1,000 engines and they need them shipped to China, let's say. So if those engines are being produced here in Jamestown, New York, and they're being shipped to China, how do you suppose they're getting there? They might get loaded in trucks, possibly. They're probably loaded in freight containers. And those freight containers, if this actually was a scenario that happened, those freight containers would probably be loaded on rail cars and shipped by rail from Jamestown, New York to probably Los Angeles. Very, very large port. Probably they're in containers when they leave the Cummins plant here in Jamestown, and they're shipped across the country by rail, which is a pretty slow process. And once they get to California, to the port, and if you know anything about current events, the port's backed up, so they could sit there for a little while before they actually get loaded on a cargo vessel. They stack all those containers onto the cargo vessel, and the cargo vessel now has to cross the Pacific Ocean to China, where they get offloaded at the port in China. And I don't know, maybe they're used right close to there. Maybe those containers are loaded on trucks and shipped inland. I don't know. I know most of the commerce in China is along the coast. Most of the wealth in China is along the coast. I know that. So there's a very long transportation process here, right? Very long transportation process. It started here in Jamestown, New York, went all the way across the country to LA, was put on a cargo vessel and crossed the ocean. It gets to China, it's offloaded, and then it's transported to its final destination where those engines are being incorporated into whatever product they were ordered to produce. Everybody understand this could be months, right? Everyone gets that? So if you're Cummins, you want to claim as soon as possible the revenue for those engines, right? And you can't claim the revenue until the product is delivered. So what do we mean by delivered? Does it mean when it gets to the buyer in China? It depends. If you're Cummins, again, you're going to negotiate that. If you're Cummins, you want to negotiate that once they're in the cargo, in the containers, and they leave Jamestown, you want to say, yeah, they've been delivered because they're now the property of the buyer. If you're Cummins, if you're the seller, you want terms of FOB shipping point, because then you can claim the revenue as soon as they leave your facility. And that's what you want to have happen. Claim the revenue as soon as possible. You've been paying the bill the whole time to make them, paying your workers, you're paying for the raw materials and so on. You want to claim that revenue, report it, and then match against it those expenses. If you're the buyer though, when do you want to take possession? Probably when it gets to you, because again, you don't have the expense You don't have the expense until it gets to you. You don't have to report that until it gets to you if you don't own it. And by the way, you're not responsible for the freight charges either. So that's a separate negotiation. So this is a very long explanation for what Patty asked, a very simple, short question. But all of these are considerations for a business. When does title change hands? It could be, and it's not uncommon in the scenario that I just described, that it could be that you negotiate an intermediate point. So it's not when it leaves Jamestown, it's not when it gets to wherever in China it's going, but maybe title changes hands and it becomes the property of the buyer when those cargo containers are loaded on the cargo vessel at the port of Los Angeles, as I've just described it. That could be. It has to be negotiated. It is part of the contract. There would be no doubt about where that title changes hands and who's responsible for the freight and when the company gets to claim the revenue. Again, I'm not as familiar in Jamestown, but there's a company in Olean. It used to be Dresser Rand, and it is now owned by Siemens. And at their facility, they have a control, they have a guard shack at the entrance to their, or exit to their main facility. And usually their payment terms, usually their freight terms, usually this question about where does title change hands, usually they have the terms being FOB shipping point. And what that means for Dresser, for Siemens, is once the and they're selling multi-million-dollar compressors. They're huge. They take very specialty trucks, usually require escort vehicles, state police to escort them. They can only run certain hours of the day and can't run on weekends and all that kind of thing. So usually their payment terms, their shipping terms are once it goes through the guard shack, once it passes outside their control, even though it's technically still on their property, it's not in the controlled access part of the plant, it's considered shipped. And so it is not at all uncommon at the end of a quarter, end of the month, to see these huge trucks loaded with these huge pieces of equipment that are all tarped and boxed, and you can't actually see them, but you can see how big they are. You can see the size of the massive trucks that are carrying them. And those trucks are sitting out in their driveway, not on the road. They haven't actually left the facility yet, but because they've gone through that guard shack control, the company is able to claim the revenue. So I'm sure that there's a similar situation with someone here in Jamestown. I just don't know who that would be, unfortunately. So I can't give you a local example that might be meaningful, at least to some of you. Okay. Any questions? Any other questions? This was in response to a question, but it's all important information, definitely things that a company needs to consider. Anybody any other questions? I don't know why my assignment score keeps showing 0 today. That's kind of sad. Let me go to my PowerPoint here for a moment, if I can up here. And for our final exercise for today, as will be the case in several of our chapters, we're going to be looking at, and we started this in chapter 4 when we looked at the current ratio and working capital, those calculations. So in most of our remaining chapters, we will be looking at, well, how do we use this information? We started out the very first day of class, we talked about accounting. I said the whole purpose of accounting is to help decision makers make decisions about our company, regardless of what type of decision they're trying to make. We're trying to give them good data, good information to help them make an appropriate decision about our company. And so in each chapter, most chapters from here on, we'll be introducing a tool that people might use to help make that decision. And so our final exercise in chapter 10 is about asset turnover ratio. And so this is one more tool in our arsenal of tools to help us. If we were someone using these financial statements, how might we use them to help us make a decision about the company, whatever that decision might be. In chapter 14, our final chapter that we will cover in our final 2 class days in December. Financial statement analysis, we'll be looking at all of these tools together and talking about how a company, or how a decision maker might reach a decision, looking at all facets of an organization. But in these chapters, we're really focusing in on something that's related to specifically what we talk about in that chapter. Remember, we talked about, I think it was just last class, I'm sure, definitely last week. We talked about needing a standard of comparison. So any of these tools, any of these financial analysis tools that we use, we have to be, we can't look at that number, the result, in a vacuum. We have to be comparing it to something. So just as a reminder, we talked about 3 different standards of comparison. We said you might compare yourself to some rule of thumb. There might be a standard number that, this is where we want to be. And if we're better than that, we're okay. And if we're not better than that, we might be in trouble. We also might want to compare ourselves to ourselves from the past, looking at a trend analysis or historical analysis to see, are we getting better or worse over time? And the 3rd standard that we talked about was comparing ourselves to our competition, either to some kind of an industry average or a benchmark of one particular company that we think is doing a really good job at whatever it is. So, as I said, our last exercise for this chapter is related to the asset turnover ratio. And this ratio, you can see the formula right there. You may want to make a note of that. We'll be using it in our exercise in a moment. The ratio, so a ratio, of course, is comparing 2 numbers to each other. We look at it as a division problem. Sometimes these ratios that we're calculating throughout this semester are expressed as number of times or as a percentage, depending on how the numbers are typically related to each other, how high that number might be. So asset turnover ratio, as you can see on the screen, tells us how good are we at using the assets we have to generate sales. So we're looking at a value from the income statement and a value from the balance sheet and comparing their relative size. How good are we at taking the assets we have and using them to generate sales? Now you'll notice the denominator, the bottom part of the fraction, is average total assets. So what that means is, again, we have to use the information we have available to us. If we are a decision maker who's external or outside the company, the only information we have is the information from their financial statements that they shared with the public. And so the 2 values we would have for assets are what were their assets last year and what were their assets this year. GAAP requires that we prepare what are known as comparative financial statements. Comparative financial statements. GAAP requires that companies provide at least 2 years of data, unless they haven't been around for that long, unless they're a brand new company. They have to provide at least 2 years worth of data. And so in the project that you just did for exam 1, you had to answer the question about how many years of data were on their income statement, how many years of data were on their balance sheet. And there isn't anyone in here who saw that they had less than 2 years of data. They're required to provide at least 2, but many of you would have seen that your companies voluntarily provided maybe a 3rd year or a 4th year. The most I have ever seen was on Dollar General's cash flow statement, and they had actually 5 years worth of data because they wanted you to see that trend. If your company only provides 2 and you want more than that, what would you do? Well, you'd go to their last year's annual report to get the numbers from the year before. Okay. So the denominator that says average total assets, that what we're going to do is take the assets from the beginning of the year, which would be the same as the end of the previous year, and add it to the end of this year, and then divide by 2. So we're just going to average them together, take beginning and end, add them together, and divide by 2. Let's go to our exercise then. And I thought we were going to have a little bit of time left at the end, but it's clear that we will not have any extra time today. And that's okay. We'll just start chapter 6 on Thursday. So let's do the asset turnover for 2023. First thing we want to do is, I'm just going to put the formula on here, not the words, but the numbers. So for 2023, we start with our sales in the numerator, and the denominator is going to be the average of the beginning and ending total assets. So we add those together and divide by 2. I've put parentheses or grouping symbols there to remind you. You know, we're going to follow order of operations, add those together first, and then divide by 2. And I found an asset turnover when I plugged that into my calculator for 2023 of 2.4. 2.4. Remember, we said this is a measure of how good, how effective, how efficient the company is at using the assets they have to generate sales. You would read this number as 2.4 times, but one interpretation is for every dollar in assets they have, they generate $2.40 in sales. For every dollar in assets, they're generating $2.40 in sales. Obviously, then, the higher that number is, the better they are at generating sales with the assets they have. Some organizations some industries are very asset intensive. So heavy manufacturing takes a whole lot of upfront assets, a lot of sunk costs upfront, where other companies such as advertising or other service-based industries may not have a lot of assets required for that industry. So there is no magic number or rule of thumb for asset turnover. It's very much dependent on the industry that you're in. Go ahead and do the calculation for 2022 if you haven't done that already. Yes. Okay. Mm-hmm. Mm-hmm. Right.
So how does the customer
so they would, it depends on whether they've already paid the bill. So if they already took a discount on that merchandise, then they would report the return without the, like, to subtract the discount from that. So if they returned $1,000 worth of merchandise, but they only paid, say, $970 for it, they would report just the $970 credit. If they hadn't paid the invoice yet, then they would report the full $1,000 reduction, and they take the discount. If they took a discount, if they paid fast enough, they would take the discount on only the part that was left. So it depends on the timing, but you don't get a discount on, they don't give you an extra discount on stuff that you return, which I think is maybe where you're going with that question. So you'd have to pay it back if you'd already gotten the discount. Does that make sense? Okay. And for 2022, then I got 2.2 for my answer. In the previous year, they were generating only $2.20 in sales for every dollar in assets. And so now we have something we can compare. How do we do this year compared to last year? Are we doing better this year? Yes, we are. The change is favorable from last year to this year. We're doing better. We're generating more in sales. Now, that's not the only consideration. If we generate more in sales, but we make less in profit, that's obviously not a good thing. So we're almost never would we make a decision looking at just one calculation like this. And as I said, that's what we'll see in chapter 14 when we pull all of this together, all the formulas, all the tools that we're learning chapter by chapter. In chapter 14, we're going to look at them all together to see that big picture. Thank you for being here, and we'll start chapter 6 on Thursday.